Recording cash transactions. The cash book. The cash book tracks your bank and cash transactions. So far, you've just looked at your credit transactions and returns. However, a lot of business will take place using cash. The difference, though, between the cash book and your sales and purchases journals is that the cash book is in actual fact a T account or a general ledger account with more detail than you would normally have. I know this might seem a little bit confusing to start with, but just imagine that you are doing a T account as you did before you learned about journals, but in this T account, you're going to have analysis columns like you do in the journals for all the different amounts or reasons why you might perhaps get money. To start off with, though, you can just have a simple cash book that simply shows you your bank and your cash on hand, and then you put the details of what the accounts are and post every item individually. However, if it gets more complicated, if you've got lots and lots of transactions, you may find it easier to have analysis columns for all the items that you bought as well, and these are then posted to the relevant accounts at the same time. The cash book is going to be totaled like you do with the journal and posted to all the other relevant general ledger accounts, but because it is itself a bank account in the general ledger, you're going to have to balance this account to show the balances for both cash and bank. There's no need to post to cash or bank as this is your T account. It is also possible to offer cash or settlement discounts. These are discounts that are often offered to customers in order to encourage them to pay faster. I don't know if you're aware, but the longer it takes to wait for money from the customer, the more likely it is that you're going to have to write it off as a bad debt. In other words, that you're never going to receive that, and that is obviously rather problematic for your business. For this reason, you want to try and get the money in as quickly as possible. It'll also save you on administrative costs and time and effort and stress. So, to try and get the customers to pay faster, you might decide to give them a special discount. This discount would be clearly stated on the invoice along with the standard terms. For example, 30 days less 2% means that if you pay within 30 days, you will be allowed to have a 2% discount. The discount that is allowed to customers obviously is going to be an expense because it will reduce the profits that you are actually going to make on every transaction. Similarly, any discount that you receive from suppliers would be recorded as an income. In both of these cases, you would have discount as one side of the transaction and then either the account receivable or payable as the other. No cash changes hands for the discount simply because the actual cash that is going to be paid or received is reduced. However, it might be very easy to forget about this discount, and therefore usually a discount column may be included in the cash book. This is not saying that a discount has actually been paid or received in cash, but simply that a discount has been allowed to a customer or received from a supplier, and it reminds us that we need to post that amount to the discount account in the general ledger, be it the expense or the income, and also to the customer or supplier's account. Keep in mind at all times that the actual cash that changes hand plus the discount is going to actually equal the amount of the debt that is settled. It is very easy to get confused here, but if you keep in mind the logic of this little equation, in order to introduce the next idea in the concept of cash journals, I'd like you to now go and do an activity. Firstly, I want you to find some friends or family and decide to go shopping with them. Yes, you will need real money and you will need to please buy real things. Doesn't have to be a lot of money, you could each just have a little bit, but I want you to please pool your money in one envelope. Obviously, these need to be really good friends who you can trust and who would trust you. And I want you to allocate one person to be in charge of the cash. This person is going to be the petty cashier. It might be you with your accounting knowledge, or maybe somebody else would like to have a chance to be in charge. You'll need to each decide what you want to buy. Maybe you would like a chocolate and somebody else would like a Coke and another person would like some fruit. And each note these on a separate voucher. Make sure that you all agree on what you have decided to buy, and make sure that the petty cashier signs all the vouchers in order to authorize them. Remember that this money that is in the envelope actually belongs to all of you, and for this reason, one of you can't go running off and buy a whole lot of ice creams and chocolates for themselves only. That just wouldn't be fair. So it's very important that all these purchases are authorized. Now that you've planned your shopping, go shopping. Make sure that you keep all your till slips and attach them to the relevant vouchers. If for some reason you've bought something from a shop that didn't give you a till slip, then just simply make a note of this on a piece of paper. In other words, try and create your own one. What you're going to do then is you are going to record your transactions in a cash book that is specifically for petty cash. Just like for the cash book we've used in the past, you are going to put the money you received on the debit side, and you're going to show the money that you spent on the credit side for all the different items that you may have bought. Now I want you to think a little bit. Firstly, how much did you all have in the envelope to start with? All you need to do here is just add up the amounts that you all put in. How much did you spend in total? This will simply be the total of all your credit transactions in your petty cash book. How much do you think you would need to put back into the envelope in order to have the same amount that you started with? Hopefully you can see that this is actually quite obvious. If you want to start with the same amount again, you need to put in what went out. In other words, the amount that was spent in total. So, let's now have a look at petty cash in practice. Petty cash refers to cash that a business might have on hand for payment of small amounts where you don't want to bother to do an EFT. Somebody needs money right now, maybe to pay for parking, maybe to quickly go out and buy some glue for the office, whatever. The petty cash will usually be controlled by a petty cashier for the simple reason that if you just had a money box that was open for anybody to come and take, I'm sure you can see the problem here. The danger is that people would take it to go and buy things for themselves rather than for the business. And nobody would know where the money had gone as nobody's responsible. For this reason, a petty cashier is generally going to be allocated, and this person is responsible for all the petty cash payments. A petty cash voucher is going to need to be completed, usually. This is simply written permission needed from the petty cashier before the cash may be spent. Otherwise, anybody could go and spend money and just come back and claim it. That's not really a wise idea, particularly in larger businesses where maybe the different employees are too many, or they are not trustworthy enough, or whatever the case may be. So generally, you need to have these slips authorized, and very often the employees will know that if they haven't had it authorized or they've spent money on something other than what was authorized, they may not be reimbursed. The money in the petty cash box will then be replenished from the bank account and recorded in the cash book. So you would credit your bank account and you would debit your petty cash account. The petty cash book, or you could also have this as a column in the cash book, especially where you've got a column for cash and for bank already, is going to be used to track the petty cash. The balance in the petty cash book could either be varying each month as random transfers are made as and when is necessary, or you might find that the business uses what is known as the imprest system. This is what you used in your little business scenario where you went shopping. In this case, you start every month with exactly the same amount. And the amount that is then spent during the month is transferred back to petty cash so that the balance is always going to be exactly the same, just like in your shopping activity that you just did. Any additional cash books or columns may also be used for any other cash accounts. For example, these days you'll generally find that there are very often credit card accounts. Many of your employees who obviously are trustworthy might have their own credit cards on the business account. Obviously, similarly, they would need to be able to justify all the expenditure, and they would need to keep supporting documents. But these credit card accounts could also be columns in a cash